Hello, good people. Today, we want to look at IAS 8's International Accounting Standard number 8. It talks about the accounting policies, changes in estimates, and the errors. So let me start by explaining the accounting policies. The accounting policies. Right. On the accounting policies, guys, we'll be talking about the principles that you follow as an accountant. We'll be talking about the principles, the rules, the practices that are applied by an entity when they prepare the financial statements. When you prepare the financial statements, what are the rules, what are the practices that you follow as an accountant when you prepare the financial statements? There is a policy that you follow, you understand? Right. So guys, on the accounting policy, you don't just change the policy. You don't just change the way you do things, you understand? You only change, you only change if it is required by the IFRS standard, or that change is going to provide the information that is what? Reliable and relevant. You get it? Right, I will give you an example. This is our statement of financial position. We have non-current assets, we have the current assets. Guys, you can have a machine, an asset, and the amount that sits in the books, let's say is 10,000, which is your carrying amount, right? That's the value of the machine. But now, guys, when you hold this machine with the intention to use it, it will be classified under IAS 16 PPE. You get it? Right. So we are saying what we'll be doing, we'll be following what the standard says. Like we'll be depreciating the asset every year. In IAS 16, yes, the asset can be revalued. There are so many things that we follow under IAS 16. But guys, what about if you now have the intention to sell the machine? Like on the machine, you no longer have the intention to use it. There are so many reasons why you can decide to sell the machine. Let's say maybe the reason why you want to sell the machine is you want to raise some cash flows, or maybe you purchased different machines. You now have new machines. So this one is, you no longer use it that much, so you now want to sell it. If it meets the conditions under IFRS number 5, under held for sale, if it meets the conditions under IFRS 5, then it will be classified as held for sale. When you have the intention to sell the asset, now it will be reclassified from IAS 16 PPE to IFRS number 5, held for what? For sale. You remove it from non-current assets, you record under what? The machine under the current assets. You understand? And that value, yes, is 10,000, but I want you to understand that when you have the intention to sell, it's now a current asset. And from that date, you don't depreciate. Are you seeing that we will be depreciating under this standard? But on this one, you're no longer depreciating. We have changed the way we were doing things. You can change the recognition, you can change the measurement, and change the presentation. If you change that, that's a change in accounting policy. Yes, because someone can ask, how do you know that I have changed in accounting policy? If you have changed the way you were recognizing things, or you've changed the way you were presenting things, or on the measurement, like on IFRS number 5, how do you measure it? At the law of cost, at the law of carrying amount, and the fair value. If there's change in measurement, or if there's change in measurement, recognition, presentation, it's a change in what? Accounting policy. Right. So that's accounting policy, right? Now, we do have changes in estimates. Let me talk about estimates. Now, we do have the estimates. On the estimates, guys, there are so many estimates that we have. Like, let's talk about the depreciation. Guys, when you buy an asset, it doesn't mean that you know the actual number of years that is going to last. You use estimates. So that's what we're talking about. So depreciation is an estimate, right? Depreciation is an estimate. Okay, what about if you say cost less residual value? Less residual value over estimated useful life. What's this? The residual value is also known as the scrap value, right? Right. This formula is used to calculate the depreciation of an asset every year, and this is what? This method we say this is straight line method. You understand? So these are estimates. You can estimate that, yes, you know the cost. You can estimate that after so many years, it will remain with a scrap value of this amount or the residual value of this amount. You can estimate the number of what years that is going to last. So guys, the topic is changes in what? In estimates. You can change the way you were estimating. Like maybe the useful life of the assets, you expected that is going to last for 8 years, but the estimate has changed. You are now estimating that it will last 5 years. You can change your estimates. So I think these are the changes in estimates, right? Even you can change from straight line method to what? To reducing balancing method, right? How do you calculate under reducing balancing method? Percentage times what? Carrying amount. Straight line, you use this formula, or you say percentage times cost of the asset. If it's reducing, it's percentage times the carrying amount. You used to call it net book what? Value. This is the carrying amount. So you can, if you change the method, you are depreciating. It's a change in estimates, because depreciation, these are estimates. You are changing the useful life of the asset. You are estimating. Those are the estimates, guys. These are the estimates. Even I can talk about warranty provision. It's an estimate. Guys, let's say you do sell furniture. You estimate that this furniture, this asset is going to last for 2 years. If you have problems, if it's no longer working properly, maybe let's say within 6 months, or you come with that asset, we replace it, we'll give you a new one, or we repay it for free. So guys, those are warranty provision. You just estimate. You don't know the actual. So you don't know how many people are going to retain faulty products at the end of the year. So you can estimate. So since you don't know the number of people who are going to retain faulty products, it also means that you don't know the actual cost that you are going to incur to repair or to replace. So those are estimates, guys. You're just estimating, right? Then we also have the errors, guys. You know the errors. So they can be the prior period errors, right? You know, so they can be prior means before, prior period errors. So they can be errors that you made before, right? Now, on accounting for these 3 things, guys, how do you account? When you change a policy, you do a retrospective. So it's adjusted retrospectively. What do we mean by that? We say going backwards. You go back and you adjust the financial statements. Now, the changes in estimates. So, changes in estimates, guys, you apply prospectively, meaning going forward. Why do we adjust going forward when you change an estimate? Let me give you this example. Let's say we acquired a machine, and the machine that we acquired, the estimated useful life, let's say it was 8 years. Right. But now, the reason why you said it is going to last for 8 years, it was so because you had hoped that after a year, you buy more machines. So you use different machines, so this one will last even 8 years is fine. But later on, after a year, you didn't purchase new machines, and you now have cash flow problems. You no longer hope to buy new machines. Then you're saying we're going to just use this one machine. So then now, you can now say, we no longer expect that it will last 8 years since we are no longer going to buy new machines. So guys, initially when you recorded 8 years and when you depreciated in the box, I will ask you a question that, was your estimate wrong? When you estimated that it will last 8 years, if you follow my example very well, was the estimate wrong? What are you thinking? Obviously, it wasn't wrong, right? So the estimate was not wrong because it was based on certain information, or like it was based on what you wanted to do. But later on, you have changed the way you are using that asset. Therefore, the depreciation is going to change. The way you are going to depreciate it, you are going to divide with the 5 years instead of 8 years. So before you were correct, but now since you have changed the way you are going to use the asset, you are now depreciating differently. Before we were correct, the estimate now is changed because we have changed the way we are using the asset. So that change is going to apply from now, and it is going to affect the future, not backwards, because what we did, it was correct. You understand? So the estimate is prospectively. On the errors, guys, if there is a prior period error, you go back and what? Adjust retrospectively. Going what? Backwards. You can't, guys, you can't leave the financial statements unadjusted when you discover that in the previous financial statements there was an error that was made. It must be adjusted. So you adjust retrospectively going backwards. That's IAS 8.